Hello and welcome to the latest edition of Bond IT Insights in 10. Thank you for joining us. In today's session, we share the latest findings of our Q3 Scorable Industry Credit Risk Report. And we also provide a snapshot of our latest performance analysis, where we actually put our predictions to the test. I'm Kerstin Volko from the Bond IT Sales and Marketing team, and I have with me today Mark Obimov from our data science team, who will share some of our performance analysis with you. So let's dive straight in and have a look at our latest Scorable AI Industry Credit Risk Report. There's some really interesting findings in there. But first, let me start for those who are new to our Insights in 10 sessions. Let me briefly explain how Scorable works. Scorable uses machine learning and explainable AI to predict downgrade and upgrade probabilities for nearly 3,000 rated corporate and financial issuers within the next 12 months. And to determine the credit risk score for each issuer, our rating transition models every single day crunches over 250 data variables, which include, for example, solvency ratios, capital requirements, profitability, efficiency ratios, etc. So really a lot of data that our model goes through every single day. And looking at the latest data, we find some really interesting trends here. So the sectors facing the highest risk of rating downgrades in the next 12 months include consumer goods at 22%, household goods at 24%, and household products at 26%. So we can see here really that brands in the beauty, health, nutrition industry, they all grapple with this, challenging economic conditions at the moment, and all this, contributes to higher credit risk. But it's not all dark clouds. Actually, for the first time since COVID, almost we see a real improvement in the house and tourism and related sectors. So, and here the airline industry really stands out. We've seen a remarkable drop in credit risk for this industry, down to 12% in Q3 from 19% in Q2. The travel and tourism industry has also improved, albeit not so drastically. But here we've seen a 3 percentage point decrease in risk as well since the last quarter. And the aggregate downgrade probability is now at 15%. I think it's fair to say that all this pent-up demand that we've seen following COVID is really giving the travel and tourism industry a much-needed boost. In summary, it's really a mixed bag of credit risk at the moment out there. So while travel and tourism have improved quite significantly, credit risk across consumer and retail sectors remains very high. But despite these challenges, there are some great opportunities in the market right now, particularly with the increased yield that many issuers are offering. Investors need to be vigilant, though, as our Scorable AI is also signaling an increased risk of falling angels, which brings us to the next slide. So yeah, falling angels do remain a point of concern. Currently, 14.1% of BBB- rated issuers across the globe face a high risk of a rating downgrade in the next 12 months. This is slightly up from the 13.4% we've seen in the previous quarter. And we've also seen a shift across regions. So emerging markets have actually seen a slight dip. So the risk of falling angels has fallen here from 24.6% in the previous quarter to now 22.7%. And however, in the US and Europe, the risk of falling angels has gone up. So in the US, we've seen the risk rise to 11.1% from 8.8%. And in Europe, we've seen an increase to 9.5% from 8.4%. So as you can see from our latest falling angels analysis, staying informed is really crucial for investors at the moment. And technology can be a great help here. But we appreciate, of course, that credit risk predictions are only useful if they're also accurate. This is why we regularly put our model predictions to the test and also evaluate its performance. And with this, let me hand over to Mark, who will tell you a little bit more about our latest performance analysis and also share a brief snapshot of the results.
Thank you. Our analysis tested the performance of our Scorable rating transition model in predicting future and credit rating changes. It includes migrations between investment grade and high yield and vice versa. As the benchmark, we used rating agencies Outlook, and Credit Watch as an indicator for future rating transitions. The validation period for our model was from 2016 to 2023, and the training period was from 1995 to 2015. The results of our performance analysis show that Scorable consistently outperforms the predictions provided by the rating agencies. First, I want to draw your attention to the table of Scorable performance analysis, in particular to the downgrade predictions. As you can see, Scorable successfully predicted 90.2% of downgrades compared to only 79% of downgrades predicted by the rating agencies. In absolute numbers, this means that Scorable successfully identified 3,043 out of 3,373 downgrades, while rating agency only identified 2,665 of these downgrades. Second, for investors, anticipating rating changes is crucial, as these shifts can significantly impact bond prices and hence portfolio performance, in particular when issuers lose their investment grade rating. And again, the Scorable model outperformed Outlook's and Credit Watch in this respect, accurately predicting 86.8 of falling angels before they happened. When we use agency outlooks only as a benchmark, Scorable outperforms by predicting 86.8% of falling angels versus only 57% indicated by rating agencies. Next slide, please. Thank you. Let's take a look at the confusion matrix of falling angels at the left. Here you can see all the falling angels distributed into 4 groups, which were predicted by the model, which weren't predicted by the model, which were predicted by the benchmark, and which weren't predicted by the benchmark. And you can see that Scorable missed only 13% of all falling angels, whereas benchmark missed about 17% of all fallen angels. But accuracy alone is not enough. Timing is equally crucial for investors. Therefore, we also compare the timing of Scorable signals to the benchmark signals. But please note that we will only consider 217 fallen angels from the table on the left. And the results of our analysis show that Scorable's model signals precede Outlook and Credit Watch signals for both downgrades and upgrades significantly in most cases. And as you can see in this example here, Scorable indicates falling angels earlier than the rating agencies most of the time. Our SRT model signals were ahead 88% of the time compared to rating agencies Outlook and Credit Watch signals. And this gives investors valuable time to move ahead of the market. Thank you.
Thank you very much, Mark. Yeah, that's great, really. And Scorable not only helps investors to detect credit risk early on, it also helps them to identify opportunity. In 2023, our model accurately indicated 78.2% of rating upgrades and thus outperformed Outlook and Credit Watch designations by nearly 25 percentage points. In absolute numbers, that means that Scorable accurately predicted 2,155 upgrades compared to only about 1,500 indicated by the rating agencies. And looking at our performance for rising stars, Scorable predicted 85.6% of rising stars compared to only 71.6 indicated by the benchmark. So I think in summary, we can really say that the results of our latest performance analysis show that with Scorable, investors can really stay ahead of the curve and make smarter investment decisions based on the latest data. Yeah, I would like to thank you very much for joining us today. If you have any questions or you would like to find out more about any of the topics discussed or what's Scorable, please reach out to us or visit our website for more detail. You can also reach out to our team directly. We're happy to share more details about our latest performance analysis or about our latest credit risk report. We're also happy to arrange a demo or a trial for you. Maybe you want to have a look at Scorable for yourself and find out who those potential falling angels are. Thank you very much for joining us and have a great day.
Thank you.